Welcome to my second video lecture of Basic Accounting Concepts and Conventions. In this Basic Accounting Concepts, I will be talking to you about various examples, but with the same company name called A Enterprise. What is Basic Accounting Concepts? It's necessary assumptions or conditions. That is known as accounting concepts. Mr. A decided to start a business by a name A Enterprise with cash worth rupees 3 lakh, land worth rupees 10 lakh, machinery worth rupees 2 lakh. Thus, Mr. A has invested 15 lakhs in all. This is a concept of business entity concept. The amount of 15 lakhs is a liability of A Enterprise and is shown in the books of account under the header capital. 3 months down the line, Mr. A needed money for his personal use. He withdrew 1 lakh from the company. As the fund withdrew was for his personal use, A Enterprise reduces the amount from the total payable to him. So the firm needs to pay Mr. A an amount of rupees 14 lakhs. This is the concept of business entity. Owner and the firm are the two distinct entities by themselves. Any money, whether in cash or in kind, introduced in the firm by the owner is a liability of the firm. Any withdrawals by the owner for his personal use is a drawings and reduces the liability of the firm. The second concept is about money measurement concept. The firm expanded its business over a period of few years. It acquired additional land for business and purchased additional machinery for increasing the production level. It also appointed a new manager to handle the day-to-day working of the firm. How do you think this firm is going to account all these? Additional machinery, land, expenses and revenues. It is a very simple concept. This money measurement concept which clears all the doubts. Only those transactions which can be expressed in terms of money are to be accounted. Value rupees 10 lakhs for machinery, value rupees 1 lakh for godowns, values which cannot be ascertained in monetary terms, that is the manager's appointment. Going concern concept. What is going concern concept? It assumes that the concern will go for a longer period. For an example, A Enterprise bought machinery worth rupees 5 lakhs. It expected to last for a period of 10 years. In that case, an amount of rupees 50,000 can be charged from the profit and loss account each year, which is nothing but a depreciation. Accounting period concept. Every transactions which can be expressed in monetary terms and related to the firms need to be accounted for. On the basis of these financial statements of a firm are prepared, these statements are used for various users, external as well as internal, such as management, shareholders, creditors, debtors at regular intervals. The financial statements are therefore prepared in regular intervals, normally after a period of 1 year, so that the timing informations are available for the users. The span of time at the end of which the financial statement of an enterprise are prepared is known as accounting period. Give you an example. 1st April 2009 to 31st March 2010. Accounting period is 2009-2010. Assessment year is 2010-2011. Second example, 1st April 2010 to 31st March 2011. Accounting period is 2010-2011. Assessment year is 2011-2012. There are few exceptions when interim financial statements need to be prepared. Example, at the time of retirement of a partner. What is cost concept? Mr. A acquired a machinery worth rupees 1 lakh for the firm. Rupees 10,000 was spent on its transportation to the firm. After 3 months, due to the shortage of such machinery, it is now available in the market for 1,50,000. At what price the cost of machinery will be recorded in the books of account? 1 lakh or 1,50,000? According to the cost concept, all records are historical in nature. They have to be recorded at the purchase price, purchase price plus its acquisition cost. That is 1 lakh plus 10,000, 1,10,000. Purchase price will remain the same for all years to come, though its market value may change. Dual aspect concept. Mr. A of A Enterprise purchased machinery worth Rs 30,000 and makes payment by cash for the same. Now these are the two things happening simultaneously. First, machinery has moved into the firm. Second, cash has moved out of the firm. A Enterprise makes a sale Rs 50,000 and receives payment by check. Again, there are two things happening. First, machinery moved out of the firm. Second, the bank balance has increased. Thus, every transaction is recorded at minimum two places in the books of account. This is called double entry concept of accounting. Asset equal to liability plus capital. Revenue recognition concept, or otherwise called as realization concept. Again, let us tell you with an example. A Enterprise can generate incomes or revenues in two ways. First, when there is an inflow of cash on account, sale of goods/services. Second, by use of other resources of the firm, for example, interest, royalties or dividend. Revenue is assumed to be realized when a legal right to receive it arises, in this case when goods have been sold or services have been rendered. Revenue is considered to be generated at the time of sale of goods or services and not when money for the same is received. Revenue in the form of rent, commission or interest are recognized on time basis. Revenue in the form of rent, commission or interest are recognized on time basis. Thus, rent from firm's warehouse for the month of March 2005 will be taken in the financial year 2004-2005, though actually received in April 2005. Similarly, interest of April 2005 received in March 2005 will still be accounted for in the accounting year 2005-2006. Full disclosure concept. This is a concept. Indian Companies Act 1956 has specified the format for preparation of profit and loss account and balance sheet. This is necessary because financial information is used to different groups like management, investors, lenders, suppliers. All materials, relevant facts concerning the financial performance of the firm must be fully and completely disclosed. Consistency concept. While comparing the financial statement over a period of time or with other enterprise, it is necessary that they have to be consistent to arrive at any conclusion. It is necessary to have a very conscious and conservative approach while asserting income of the firm so that the profits are not overstated. Let us take a hypothetical example, which is three entries in trial balance: opening stock, cash and capital. Let us pre-assume that no transaction take place during the year, which means the firm has neither made any profit nor loss. Now, at the end of the year, market price of the closing stock is Rs 70,000, whereas the cost price of the same is 50,000. If the firm takes a higher value for accounting, then it seems that even without a single transaction, the company owes Mr. A a sum of 1 lakh instead of the original value 80,000. If profits are overstated, it will lead to a distribution of dividend out of the capital or reduction in the capital of the firm. The concept of conservatism requires that the profit should not be recorded until realized, but all losses, even those which may have a remote possibility, are to be provided in the books of account. If the market value of the goods purchased has fallen down, the stock will be shown at the cost price in the books. But if the market value has gone up, the gain is not to be recorded until the stock is sold. This is called as conservatism approach. Materiality concept. The concept of materiality requires that accounting should focus on material facts. Efforts should not be wasted in recording and presenting facts which are immaterial in the determination of income. Objectivity concept. Financial statements are put in for many uses, namely creditors, management, lenders, investors. Hence, accounting should be free from bias of accountants and others. Thus, every transaction should be supported by a verifiable document name called voucher. Thus, to summarize the accounting concept, It is referred as a fundamental ideas or basic assumption underlying the theory and practice of financial accounting and are the broad working rules of accounting activities. Now let's go into the accounting conventions. Accounting conventions, there are 4 types: materiality and conservatism, convention of full disclosure, prudence, principles of consistency. Materiality. Materiality concept is used to judge what sort of transactions or items are significant and their classification in the financial statement. For example, a box of paper clips can be used for several years. It will not be recorded as a fixed asset because it is an immaterial value. Convention of full disclosure. Information relating to economic affairs of the enterprise should be completely disclosed, which are the material interest to the users. Proformas and content of balance sheet and P&L account are prescribed by Companies Act. This does not mean that when you disclose the whole thing, it leaks out. Many informations are leaking out from the business. Prudence concept. Prudence concept ensures that the net assets and profits of the business are overstated. Thus, revenues should not be anticipated. Expenses should be anticipated. Principles of consistency. Consistency is the keep using the same accounting method on similar items except for special cases. Example, a company's depreciates the machinery by using reducing balance method. The proprietor wants to overstate the profit by changing the depreciation method. This violates the principles of consistency.